Bring in G Squared Private Wealth CIO and CNBC contributor Vicki Greene and Carson Group Chief Market Strategist Ryan Detrick. Happy holidays to both of you. Thank you so much for joining us.
Absolutely.
Thank you.
All right, Ryan, let's start off with you. You're a big believer in the Santa Claus rally. According to you, we had that strong day on Christmas Eve, up over 1%. The historical data shows since 1969, that means we're in for a gain during the rally of 3%. Today was a little bit wobbly, though. In your mind, did you see anything that shook your confidence that we're going to see that Santa Claus rally pull through?
Yeah, Frank, thanks for having me back, and hopefully everyone's having nice holidays, and here's to a good new year. So, listen, as everyone has talked about, Santa Claus is here. It's that time. We're up over 1% on Tuesday, and I took a look. Like you said, we tend to see actually better returns the rest of Santa Claus when you have a good first day. But getting more specific, kind of like what Jonathan Krinsky just talked about there, look what happened today. All right, small caps up over 1%. I get it. Sometimes small caps are a dirty word, but we are seeing more participation. We are seeing things broaden out a little bit. If you ask me, we can look at small and mid-cap participation, so I like that. And again, let's just think about this. This is one of the most seasonally bullish periods of the year. We came into it extremely oversold. Number of stocks over the 200-day moving average, number of stocks over the 10-day moving average, very, very oversold. Where I'd be worried is if we actually sold off, right? When do market crashes happen? When you're oversold, not overbought. We're not doing that. I'll be very clear. We're not doing that flat on the day for the S&P. I get it. But I guess put a bow on this. We're encouraged by the action so far. And if you have a bounce during this seasonally bullish time period, it's really, not a big signal either way. It's when Santa doesn't come to town, and we're not seeing that so far.
All right, Ryan, I'm going to have to push back on that small cap theory in just a second. But before we get to that,
Sure.
Vicki, I want to come over to you. Happy holidays to you as well. We've been looking at the action on the 10-year. It's pulled back a bit from the highs that we saw earlier today, but concerned all about this higher yield situation despite the Fed cutting. I mean, if you just go back to that hawkish cut, we're up just about 20 basis points. Does that concern you about the equity market going into the new year?
Not yet. I mean, it's been an ugly December. I think it's 40 basis points basically moved up here in December on the 10-year. Until it hits 5, I'm not too concerned. I think we're going to top out around where we did in April, around that 4.7, 4.75 area. But there's some good resistance here. So again, I'm not too worried yet. Been an ugly move up, horrible on duration, biting a lot of people's bond portfolios that moved out into that intermediate space and dragging a lot of those negative on the year. But for us, it's not a problem for the equity market yet. Obviously, if we breach 5 and continue to march higher, then I do get a little bit more concerned. But right now, we're still within our inter-year trading range. And so for me, it's a little bit of an eye raiser, but not an actual problem yet.
Ryan, what do you make of what's going on with the 10-year relative to expectations for the Fed? You say that you believe there will still be 2 cuts next year. You don't think it's going to be a no cut or even hike scenario. But does it even matter if market rates are, in such a disconnect territory from what's going on with the Fed?
That's a good question because, listen, why are rates higher? I mean, is it because inflation's really that much higher? When you look at the CPI and some of the data we saw, we'd say no. It's because the economy's still strong. So, what's really worse? If the Fed cuts 100 basis points next year because the economy is slowing or because the economy is pretty solid? Of course, we would argue we'd prefer the economy to be solid. But adding to what we just talked about there, yields higher above 10% on the 10-year, yeah, that might be something to upset the apple cart. But the U.S. dollar is that big one, right? If you continue to see strength in the dollar, look what's going on in Germany, look what's going on in France, look what's going on in China. There are some disappointing things happening, right? If the dollar continues to strengthen, that's one of our, I'd say, top 3 worries next year, because when the dollar is really strong, everybody, that's when things don't do that well. Look at the first 10 months of 22 for a reminder of that. But we're optimistic that the dollar will start to roll over, that yield will start to roll over. Is the realization, again, that if you look at inflation, I know we can talk about it all day, keep it real simple. You look at inflation, why is it higher? It's because of shelter and auto insurance. I mean, those are the 2 main reasons we're having excess inflation on the CPI. So we're optimistic inflation is not a problem, and there will be more cuts coming next year than we think right now.
Vicki, are you worried at all about a policy error in 2025, just given all these cross currents and kind of unprecedented dynamics that we're seeing on the macro front?
Yes, our 2025 outlook is called bullish with a but, because there's so many things that could go wrong on the policy side, both fiscal and monetary. First off, monetary. Let's make sure the Fed doesn't get it wrong and we don't have a transitory situation again here in 2025. We want to make sure they move slow, but they are reactive if they need to be. And it's a hard job. When do you need to be aggressive? When do you need to sit back? And I know inflation has been super sticky. I tend to think inflation is not coming down all that much because housing is super stuck right now. But for us, it's also then what happens on the fiscal fiscal side, there are so many expectations baked in, and we think they could come true. We're looking at tax cuts, lower regulations, things that are going to stimulate the economy, but you have deficit hawks out there, you have Doge out there, and government expenditures and government employment is a large part of our economy. So you suddenly have these cross currents that make a lot of choppy waters, kind of like Magellan Strait area, that we can navigate it, but it is a lot more dangerous sailing next year. And that's why I say it's bullish with a but, because a policy error is that tried and true way for a bull market to end.